In the last video, we discussed the reasons that made the RBI to pose a rate cut in December. The rising inflation poses a challenge to the central bank from using the repo rate tool to stimulate the economy. It is in this scenario the RBI has used the instrument of open market operation. In simple words, open market operation refers to the buying and selling of government securities to regulate the liquidity in the market. For example, if the RBI wants to inject liquidity in the market, it would buy government securities. On the other hand, if it wants to curb the liquidity in the market, it would sell government securities. In December, RBI announced the first round of open market operation by purchasing 10,000 crore worth of long-term government securities and selling 10,000 crore worth of short-term securities. The aim of this open market operation was not to regulate the liquidity in the market but to lower the long-term bond yields, and it came to be known as the Indian version of Operation Twist. Operation Twist was first used in US in 1961 and then in 2011 to lift the US economy out of recession. The aim was to lower the long-term bond yields by keeping the yields of the short-term bonds unchanged. Bond prices and bond yields have an inverse relationship, which means higher the prices, lower will be the yield, and lower the bond prices, higher will be the yield. In the current scenario, when the RBI is buying long-term bonds from the market, its demand increases. With an increase in demand, the bond prices also increases. When the bond prices increases, the bond yield would come down. Thus, by purchasing long-term bonds, RBI aims to lower the long-term bond yields. There has been a lot of discussion regarding the fact that the consecutive rate cuts by the RBI has not been effectively transmitted to the customers. Through the open market operation, the RBI targets to lower the long-term bond yield that would benefit the long-term borrowers as it would bring down the cost of borrowing. Thus, the purchase of long-term bonds by the RBI would push up the prices of the bonds that would bring down the yield of the long-term bonds, benefiting the long-term borrowers. This, in turn, will have a positive effect on the consumer spending and would help in reviving the consumption demand in the economy. Similarly, the investors in long-term bonds will also benefit, as higher bond prices will lead to better returns. However, the interest rates of small savings schemes such as National Savings Certificate and Public Provident Fund will register a decline, as their interest rates are linked to the yield of government bonds with similar maturities. The lower bond yield will also benefit the governments, as it would enable the government to borrow money at a cheaper rate. However, the widening of fiscal deficit and additional market borrowing by the government could reverse the trend in the bond market. Thank you.